Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, we're going to discuss the supernova season. Right now, day trading is on fire. So I just want to do a quick lesson on how you should approach day trading, especially with the type of volatility that we're seeing today. You're going to want to watch this video. Today, we're going to discuss picking a strong stock. Just want to take a look of what makes a stock so volatile and so strong for day trading, and having an approach. How can we approach these stocks, especially like when we look at the market today, DWAC PHUN, they're all spiking so much. How do you approach it? The first thing for day traders, they look for volatility. Volatility is what makes day traders money. If a stock is just not moving and it has no volume, then there's not going to be much hype and there's not opportunity for day trading. So day trading is totally different than investing. When you're day trading, you're looking for the fluctuations, you're looking for patterns to form, and you want to take advantage by buying a stock when it's either dipping or at a reasonable price around support or something. And as it spikes up, sell. Or some investors look for the opposite. They look for the spikes. They look at something like this and they'll say, okay, it's spiking so quickly. It's about to hit past resistance. I think it's going to hit this resistance and then turn around. So they'll jump in here and it'll spike up a little bit more. Then it'll go ahead and reverse. And these are how some short sellers think. But none of this can happen if there's no volatility. It's not investing. Investing, you don't really care about technical analysis. You don't care much about volatility. You care about the fundamentals of a company. Is it something you want to invest in? Is it a company that has a moat that you're comfortable with financially? Is it undervalued? And you just want to buy and hold for a long time. Well, day traders, they set up hotkeys so that way they can jump in and jump out of positions within seconds. I have a day trading account. I use Lightspeed. And I'm able to jump in and jump out with a push of a button. You need volatility, and that's what's going to cause price movement. Regardless of what you learn with day trading, if you learn every pattern, if you learn every technical analysis, every support, everything that traders use, there's some traders that swear by the MACD, there's some traders that swear by the RSI, there's some traders that swear by this moving average, by the EMA, the SMA. Whatever it is, whatever you learn, you have to understand that everything is all mental. Even if you have a moving average, why does it become a moving average? Why does support become support? Why does resistance become resistance? It's not like there's a magical support line and the stock drops to that support line and it knows to reverse now. No, it's all mental. People see that support line about to approach and they all jump in because they feel like that's where it's going to be bought up. That's where the dip is going to be, and it reverses. It's all mental. And this is the same thing with moving averages. That's why they talk about picking the most popular moving averages. Let's say you pick the 200 simple moving average. It's very well respected, very popular. And a lot of stocks, sometimes when they retrace, they bounce off that moving average, and they reverse. It's pretty well known, but it's known because everybody sets that moving average. It's popular. It's well known. Now, let's say you come with some magic formula. Oh, I have the 275 moving average with a 300 and something EMA. Why would it reverse? No one knows that moving average. No one knows that EMA. No one knows that SMA. It's not going to reverse because no one's going to buy it there. Day trading is so much mental. And FOMO is one of the biggest killers of accounts. I've worked with a lot of traders in the past, and just trading myself, FOMO has killed me. If you look at the market today has had some of the biggest supernovas, just biggest spikers that it's had all year so far. And I've been trading for over a decade, and this is common. Sometimes we have that season where just for a couple of weeks straight, something sparks off the day trading market, and we have these supernova stocks. But there's a lot of other stocks that start moving for no reason, and it's called sympathy plays. because people see the main play. I think it was DWAC, for example, the Trump play. It spiked all the way up to $170 something. And after it gets that high, no one's going to start buying that high because they feel like they missed the move. So something else starts moving, and PHUN started moving, and CTRL, I think, started moving. A couple other stocks, they're called sympathy plays. People jump in those stocks because they want to make the next move. They wanted to catch it early because they already missed the other one. And that's what the fear of missing out is. So the trader with a plan, he conducts analysis, he follows news, he sets a comfortable risk to reward ratio, he sets a sensible stop loss, takes profit, follows a plan, keeps a logs. So these are all steps that a good trader, a trader that wants to survive, a trader that's been trading like myself. I've been trading for 10 years. You can't trade 10 years. And it's well known in day trading that there's such a high attrition rate. So you can't be a day trader for 10 years and not have success. It's just impossible. And I've seen a lot of day traders come and go. You have to have a plan and stick to the plan. If you look at today and you look at the charts, it's all over the place. Today, the supernova stocks jump up and down. It's up 30, 40 points, then down 30, 40 points. Those are all people losing money. I mean, there's people, a lot of people making money and a lot of people losing money. But you have to have some sort of plan. So for me, for example, I'm okay missing out on those big moves sometimes because I have a plan. If I say, for example, I'm jumping in this stock at 8 and I'm going to start taking some profit at 860 because that's where resistance is. And let's say I have 2,000 shares at 860, I might take half my position. And now I'm in the driver's seat. That's my favorite setup. If I already took profit at the point of resistance, now if it drops back down to 8 and that second 1,000 makes nothing, that's fine because I made some money with my first 1,000 shares. I'm comfortable with that. That's my comfort zone. But if it spikes, then it spikes. Let's say I'll estimate another resistance point that I think is going to come and I'll take half again. And let's say it spikes $300 and I missed out on the move because I took profit early. I'm comfortable with that because what's happening today with these supernovas only happens a few times a year, if that. But the way I play, where it hits the resistance, happens more often than not. There's a higher percent chance that it hits these resistance points that I set and then it starts to reverse. Never trade with emotion. Always trade with a plan. So here, this is pure FOMO. This is pure irrational movement. This is greed. This is fear. That's what all this represents. This stock, and I remember this, it went from, I think, under $1 or whatever trading, and it spiked all the way up here. Spiked here and then crashed all the way back down. And this kind of movement it's so much opportunity to make money, but you have to have a plan. It got up here because people bought it up here also. So think about the people that bought it up here and then it crashed all the way down here. When did they get out? Did they have time to get out? Did they have a plan? Did they just jump in and close their eyes? This is just all based off of emotion. There's nothing here that HMNY did that warrants a spike like this. This is just all emotion. No planning, just fear. We have to have a plan. So what does a plan or strategy look like? Well, that's going to differ from person to person. Everybody has their own style of trading. I like to jump into stocks that have clear, defined risk rewards, clear, defined support, clear, defined resistance. So I know where my exit is and I know where my take profit is. So this is just one pattern. This is a typical bull flag pattern. This is a great pattern to start off with to learn. And we're going to look at today's stock that spiked up. If you wanted to jump in, you should jump in on a pattern like this, where it has the initial spike, right? It has the spike, you missed it, went down here, spiked again. Then it spiked. Now it's starting to pull back. There's a couple red candles and you want to get in. You see this forming. So from here to these two candles, it made a big spike. But now it's kind of like consolidating. A trader sees this, they see these three candles and they see it, okay, it's forming a bull flag. And if you see this arrow here, then put this arrow here that's shaped kind of like a flag. And that's the reason that they call it a bull flag. You have this, you want to jump in. Now you know, okay, my support or my exit strategy is the low of this candle here. So this candle, let's say it's 250. I'm going to jump in on the break of this candle, and I'm going to exit if it doesn't continue and get out on this candle. It has its pattern. It breaks out of the bull flag, and you can jump in now, right? Because it broke out of this bull flag pattern. It's starting to spike. So you jump in here at 290. You have profit here. It's 30 cents. You know, with 2,000 shares, that's $600. But like, let's say you jumped in here and it dropped back down. Well, you know you have to exit here, the low of the candle. This is clear. It's well known. It's respected. Every day trader knows what a bull flag pattern is. It has your exit strategy, and you can set a target zone of when you want to start taking profit. But you have your stop loss. You have your profit target. You know where your entry is, and you have a plan. And what happens sometimes, what forms bad habits is it drops below this. You take your loss, then it turns around and goes up. And that happens sometimes. And then next time you say, okay, it dropped here. You don't follow your plan, and then it just goes all the way down. That's how you get yourself into trouble. Someone will say, look, I saw it reversed. I should have held. Well, no, you should stick to your plan and do it every single time, because this plan, the plan that you have, is what happens more often. You want the odds, you want the probability, you want to go off of percentage wise, and this is what happens the majority of the time. When it breaks the low of the candle, it just starts the downtrend. We look here, this is a major spike, you know, just in one day from $2 to $5.69. That's over 100% spike. And what causes this is, one, we said volatility. It's a perfect storm. So we have volatility, catalyst, something caused this spike, something got it going. There was some sort of news headline, something that caused it to go. Former runner. So some stocks, you know, they have a previous history of anytime they get a catalyst, they spike up. So people know the ticker. There's a lot of day traders. They know certain tickers. They know that if it has some sort of catalyst, it's going to run. All these things are a part of the perfect storm. Supply and demand. Now, if this stock has 1 billion shares circulating and float, there's no way it's going to make this move. It's just too many shares. So supply and demand, this stock probably has under 10, 15 million shares circulating. So if you have a bunch of day traders, they're going to buy all the stocks, and it's just going to rotate and rotate, and it's going to cause this spike. Demand comes from the news and technical breakout. Let's say this was below some sort of moving averages. Some news came, it broke out of those moving averages. It's a former runner. There's a catalyst. There's volatility. It's low float. All these things make this perfect storm. So again, like we mentioned before, former runners, like look at this stock. So let's say this stock here today starts spiking up, and it's a low float stock. It's got a catalyst, broken out of some moving averages, and on top of that, it has a history of spiking. Look, on this day, it went from 45 all the way up to 65 or 70. On this day, same thing, spiked. This day spiked. This day, the biggest spike from 0 to 135. If this starts spiking and it breaks out of some technical analysis pattern, like here, you see it breaks out of these moving averages, and it starts having hype and the volume starts increasing, then it's something you probably want to take a large position in, because it has a history of running. But I wouldn't get too greedy. I wouldn't expect this. So you see every time though, look, it spiked up, spiked up, spiked up. None of them match this, because people are waiting for that. So for me, I would just look at this pattern and I say, you know what? I jumped in here. I'm going to take profit here because I'm following this. But let's say it goes all the way up to here again. Someone might say, hey, you had paper hands. You know, I held it to the top. I did this. Well, that's good for you. Congratulations. But you took the probability that has the less chance of success. I had a plan. I followed a pattern. I saw that every time it spiked, it's not spiking as high as the previous spike. So I want to get out early before it crashes, because sometimes when these things turn around, they turn around so quickly that you have no time to get out. Build your criteria for stocks. Look for strong trends. Make sure your stock has as many strengths in your favor. So there's technical analysis, there's fundamental analysis, there's news, there's volatility, there's low float, whatever your strategy is. Now let's look at the stocks that we're trading today. So we have DWAC. This is the Trump SPAC. It came out then just drop, but then it's been on an uptrend, had a lot of hype yesterday, went as high as $51, and then in the aftermarket as high as 70. It was obvious that the next day it was going to come with a lot of hype. Pre-market spiked up to 94, pulled back here. Pre-market strategy, one of the strategies I just teach is the pre-market breakout. If a stock spikes up and drops, I like to see it form some sort of channel. And then if it breaks that channel pre-market, I have my entry and I also have my exit. It's the low of the channel or halfway down. So this one is spiked up here, then kind of went down, pulled back, and then it formed a channel. So your entry would be right here as soon as the market opens at 92. Now, if it turns around and crashes, well, you got a long way down. So, you know, you would want to take your stop loss maybe a point below. But this one has so much hype going already, and it spiked all the way up to 175. I bet you if we look at the float, it's going to be low. And without even having looked at this, because this is a new stock, I don't even know the float, but let's take a look at the float. So yeah, look at this, 37 million shares outstanding. So only 37 million shares are circulating. That's not a lot at all when you consider the volume, and there's only 37 million shares. It's going to cause a major spike. And look at here. So here we have kind of like this VWAP bounced here off the 74. People see this, that this is VWAP, and they jump in, and now it reverses again. This caused a spike, but now let's look at a sympathy play. So this is PHUN for no reason. There's no reason why this should be spiking, but it did spike, and it spiked. And if we look at and compare it to, DWAC, look how similar they are. So this one here had some hype yesterday, and people figured, you know what, I want to jump in this one because I missed DWAC. Trading up here at 174, not as many people are going to buy it at that high price. PHUN ran. And there was another stock that ran, CRTD. So PHUN, look, and let's take a look at the float real quick. So 9 million shares circulating, 76 million shares. So they a little bit higher. Float shares outstanding, 49 million. So a little bit higher, but that's because they've diluted themselves. But still, low float. CRTD today was on fire. Again, look at this. Almost the same pattern as this. As soon as this one died out, everything else died out. So this one spiked as high as 976 and dropped all the way down to 423. And let's look at the float on this one also. Look at this. Only 8 million shares circulating, 3 million shares. All stocks that have a low float are volatile and moving because of hype. So you see here, day trading is all mental. All this is psychology, right? The SPAC started off, the Trump SPAC started getting hype, gained momentum, caught a lot of attention. Day traders wanted to trade it, and it caused the $15 stock, $20 stock to go as high as $170 in one day. I mean, there's amazing opportunity to make money. But then you see the sympathy plays, they spike up with that spike. And then when that WAC crashes, they crash with that. So you see that day trading, you have to master your mental. You have to understand what the market is doing, and you have to have a plan. Having a plan, just looking at this chart here, you can identify, look, you could have done maybe this bull flag here, right? So it spiked up, you missed, 762, drops down all the way to 585. So then you kind of see the breaking out of this bull flag pattern. You can jump in here at 676. Now, if it drops back down to 588, that's your stop loss. But you want to start taking profit, and you start taking profit the high of this candle. So 753, start taking some profit here. And now you're in the driver's seat. Now you're in control, and you can try to let it ride out. The problem is, like with these stocks, once they start crashing, and sometimes they go into a halt, because the orders to buy, there's too many buyers, too many sellers, and it's a mismatch, and it just stops for 5 minutes and restarts. At least here you would have a plan. And if we look at DWAC, I mean, this is something that you probably, if you didn't play it pre-market, like for me, if I didn't catch this pre-market breakout here at 93, so you see, like pre-market wise, if I was looking at this, it spiked up, then I saw it go down, then I saw it kind of consolidating, I would jump in here, pre-market breakout. But if I missed that, which I did today. I didn't even, I didn't trade it, so I missed it. If I saw this, look at all these green candles. Look how much it spiked up. I don't think I would have jumped in. I mean, I would have just missed the whole move because this is so rare. Like, it doesn't happen often that you get so many green candles, such a big move from 90 to all the way to 170 without a pullback, without anything. So I would have been too scared to jump in this, and I would have missed it, and I probably would have had some FOMO, and that's why FOMO is so dangerous. I mean, as I'm talking about it, of course I would have had some FOMO, but you have to overcome that. You have to fight it and just turn it off. I did one trade today. I saw all this movement, and then I shut it down, and I decided to make a video. So that's my plan, and I try to stick to it. But if you want longevity, you have to have these plans. And that was my video. I hope you enjoyed it. Please don't forget to subscribe, comment, and like, and see you on the next video.